How to prioritize where you save to maximize what you save. Why you might want to retire in the great state of Georgia. How waiting just one more day before you retire could save you a lot of money. And how to totally screw up your retirement. This is Your Money, Your Wealth. Today on Your Money, Your Wealth, 2/3 of Americans aren't saving for the most expensive purchase of their lives. And today, Joe and Big Al have solutions. Big Al lists the 8 IRA-related mistakes young professionals and everyone else should avoid. And Joe breaks out tax breaks state by state to help you decide where to retire. The fellas also answer email questions on advisor credentials, what to do with your 401k when you head off to grad school, the 60-day rollover rule, and which is safer, T-bills or fixed indexed annuities. Here are Joe Anderson, CFP, and Big Al Clopine, CPA, to clear it all up for us.
There's such a disconnect when it comes to retirement planning, and everything else. I think everyone knows that they need to save.
Yes, that's true.
But if you look at life's most expensive purchases, right? Merrill Lynch came out with a study.
Oh, I saw that article.
Yeah, did you?
Mm-hmm.
Yeah, our crack research team is hot.
Yeah.
So, did you read it?
I did. It was very short.
Yeah, that's why I grabbed it.
It was under 100 words.
Yes, so
I memorized it.
You could read the whole thing in about 30 seconds. That shows you. All right.
It was one of those where you had usually you have slides and they have 10 or 12 slides. This had 2.
Yeah, I don't even look at the slides. But the study shows average cost of retirement is 2.5 times that of an average house.
Yeah. So what, $700,000, I think?
$700,000. Yeah. The average cost of retirement is more than $700,000, or about 2.5 times that of an average house, and 9 times more than the average cost of college education.
Got it. So in other words, it's your most expensive purchase is retirement.
So if we want to compare, the average cost of a home is $278,000.
Okay.
All right. The cost of college education, take a guess. What do you think?
Oh, I don't know.
$83,000.
Say $100,000.
That's what you paid per quarter.
That's
for one of your.
That was not my experience. Out of state, Colorado, University of Colorado. No, it was more than that.
Okay, and then the cost of raising a child to age 18, $245,000.
Oh wow! So retirement. Yeah, that's the most expensive purchase.
All right. So despite retirement's hefty price tag, the report goes on.
Right.
The report finds that 81% of Americans don't know how much they need to fund their retirement. In addition, a growing number of younger generations think they'll need to personally fund a larger portion of their retirement, to therefore expect to rely less on employers and the government.
Okay.
But that's always been the case, and we've talked about that in the past. I think every generation felt that they weren't necessarily going to get a huge subsidy from the government or whatever.
It does continue, but there is always that concern.
All right, so $700,000 price tag, folks. That's what you have to shoot for. That's on average.
That's on average. Our listeners is probably a little bit more.
It could be.
Yeah.
Right? It depends on, of course, and we can go through the arithmetic of how much money that you want to spend and what other fixed income sources that you have, how old you are.
I mean, if you want to spend $100,000 a year and you live 25 years, that's $2.5 million. Right?
It's a little bit more than $700,000.
Yeah.
Good math,
now,
right off the cuff there.
Just like that, huh? I don't need one of those fancy calculators.
No,
you
don't.
Do that in my head.
But still, all right, so then I'm looking at this and I'm like, $700,000, that's a lot of money. And I would say most of our listeners are saying, wow, that is a lot. And then so there's either two sides of the coin. I wouldn't say half, but some of our listeners are saying, hey, you know what, that's pretty good because I think I have that. But I think the other half, or maybe the majority, are saying, man, there's no way I'm going to get to $700,000.
Yeah, I would think a lot of people would say that.
And then I looked at this. 2/3 of Americans aren't putting any money into their 401k plans.
2/3.
2/3,
That's
Clopine.
crazy.
So you need $700,000 to have a retirement, and 2/3 of Americans aren't putting money in their 401ks.
And usually when you have a 401k, you put some money in, and so does your employer. There's a match. So why wouldn't you do that?
So here's what this latest study did, because, we talk about studies and censuses and things like that.
Yeah.
But what they did is they took a look at the actual tax returns, right? And so instead of surveying an individual, right? Because, all right, you get a phone call or something like that. Hey, are you saving into your 401k plan? What do you think? Of course I am.
I did. They don't ask the second question, when? Well, yeah, about 20 years ago I did.
Right. Well, are you saving for retirement? Yes, absolutely I am.
Yeah.
Right?
I got a slush fund. It's got $100
yes. It's like, yes, of course you're going to answer that way. So they're like, you know what? I think people might be lying to us.
Yeah, well, I learned that as a tax accountant. I mean, people always say they made money on their investments, and then they brought me their tax returns. They almost always lost money.
Clopine, I'm pretty good at picking stocks. Well, I'm looking at your tax return. Your Schedule D says the opposite there, buddy.
But then if they're sophisticated, they say, yeah, but I did tax loss harvesting. And I would say, okay, all right, you got me there.
Yeah, whatever. So here we go. So they analyzed W-2 records from 2012 and identified 6.2 million unique employers. So there's 6.2 million unique employers.
Really? Okay.
And 155 million individual workers who held 219 million distinct jobs.
Okay.
So they took a look at all of that and they said, you know what? Out of all of that, only 14% of employers actually offer a 401k plan.
14?
14%.
Yeah, well, partly because most of those are super small. They're 1 or 2 person companies.
Bigger companies are the likeliest to hold a 401k plan. See, you probably read this one too.
No, I didn't.
I got nothing on you.
I got that knowledge in the noggin.
But then they said this is that, all right, well, then they estimate about 79% of Americans work at those places, right? At the larger employers.
Okay.
So let's just call it 80% work at an employer that has a 401k plan.
Okay, nice.
Right? So the other 20% work at a small company. Maybe I'm a sole proprietor. Maybe it's a 1 or 2 man shop, right? That you're referring to.
Sure. The old Clopine Financial days.
Yes. Well, you had, 2 or 3 employees?
Myself and I don't know who else.
All right. So 80% of the people that have a 401k plan, how many people then are, it says here that just 41% of workers at those employers are making any contributions to the plan.
So you're saying about 60% are not putting any money in at all?
Correct.
Wow. That is shocking.
So how do we connect the dots here? How do we create solutions? Because we got emails over the past couple of weeks.
It's like you guys bring up problems and never have an answer.
It's like, well, if you're looking for solutions, you're listening to the wrong show.
Yeah, there's probably a way better show than ours.
Yes. We just talk about problems all day.
Yeah.
Yeah.
Yeah, what is the solution?
Well, it's easy. It's save a little bit of money.
Okay.
It's just save a couple of bucks.
Put some money in your 401k.
$700,000. I mean, if everyone would just shoot for that, I mean, not everyone, but most people that are listening to the show, right? Because there's a lot of you that are making several $100,000 a year, and you don't have several $100,000 saved.
But I was thinking about that, Joe, that little snippet article that you just quoted, and I was thinking $700,000, the cost of retirement, but it's not all funded from you. I mean, let's say you get $30,000 in Social Security each year. So in 20 years, that's $600,000 of the $700,000, just right there.
Right.
So it's not like you have to have $700,000 in the bank.
Exactly. And here's another thing that's also skewed a little bit by the industry itself, is saying the average cost of health care for a 65-year-old couple is going to cost you $250,000.
That's right. Exactly.
So then they're thinking, man, do I need $250,000 additional
today,
right now, just to cover those healthcare costs?
Right.
No, not necessarily. But you have to look at, there is a true cost of retirement.
Right.
$700,000 is pretty low, to be honest with you.
Yeah, for our listeners, I would agree. People that live in Southern California, we have a more expensive lifestyle, so you got to plan on more than that, probably.
Well, no, just like with your math, if you have, I mean, that's just the actual expense, right? So if you have, let's say you're married, you have $1,500 or $15,000 of Social Security coming in, your spouse has 15, right? So that's 30,000.
Yeah.
30,000 times what? Would you use 20?
I used 20 because it was easy. 600,000. I just do easy
3
math
times
in my
2
head.
is
3 times 6. Add a couple zeros.
Yes, all right.
See how good I am.
Carry
at
the
that?
1.
No carrying.
So then at that point you need $100,000. Then you're good.
Yeah.
But what's the average balance of retirement account?
Well, we know it's well below 100,000. Yeah. Right.
So I guess the point of the solution here is just to take a look. And all right, so let's say two things, is that if you work for a small employer or maybe you're a sole proprietor, you still have options. You have a 401k plan that's available to you. It's called a solo 401k.
Right.
You can set up your own individual 401k, which is phenomenal. You can put $24,000 pre-tax. If you're over 50, $18,000 if you're under 50, or you could put in 5,000 or 2,000. It doesn't matter. It's a defined contribution plan. You can put in some years a lot, some years a little. It doesn't matter. So everyone has the ability, right, to basically set up their own retirement account. If you don't want to go to a solo 401k plan, you can set up a SEP plan. You can just do a standard IRA. Depends on how much money that you're making, how much money that you want to save. But there are options. But the problem is it's not as easy as working for an employer that has that 401k plan where I could go to HR, get the paperwork, and say, all right, yes, I want to put 4% of my salary, deferred into the retirement account, out of sight, out of mind, forget about it. Where if you don't have the luxury of those plans, right, then you actually have to do a little bit more work, right? You have to establish your own plan, either through a mutual fund company, such as like T. Rowe Price or Vanguard or whatever funds you like. Or you could go to a brokerage firm like a Merrill Lynch or Morgan Stanley, or you could go to a discount brokerage firm such as Charles Schwab, TD Ameritrade, or Fidelity, something like that. But it's not as difficult as it might seem. It's just another step in the process.
$700,000. Okay, so retirement is expensive. Between declining income, increased longevity, and high costs, retirees run the risk of outliving their assets. Learn how to mitigate these risks. Download the white paper on America's retirement crisis at purefinancial.com. Click on the Learning Center and go to white papers for your free download. That's purefinancial.com.
We're talking about how much money. Let's just say if you save, $5,500 into a standard IRA.
Yes.
So everyone is eligible to do an IRA contribution.
Correct.
Unless you're over 70 and a half.
Correct. Because a lot of people don't have retirement plans at work. You have to have earned income, so you have to have a job, or you have to be self-employed, a profitable self-employment. But let's just say you max out an IRA each year starting at age 25. You go to age 65. 40 years, you put $5,500 into an IRA. Now, of course, you can do $6,500 when you're over 50. But I'm just keeping it at $5,500 per year, 40 years, 7% rate of return. Guess how much you would have at retirement at age 65? You would have $1.1 million. Right? $5,500 per year, right? And so a lot of people say, there's no way I can save for retirement. $5,500 is something that you can do and should do. And if you do this repeatedly year after year with compound earnings and growth, it's amazing what can happen.
Yeah, but then you have to start saving at age 25, Al.
Why not? Why shouldn't people be saving at age 25?
I agree with you,
Right.
but there's a lack of information and education when it comes to money with people in their 20s, because it's
True.
like, okay, well, here, I'm just trying to pay off student loan debt. I'm trying to, get out of mom and dad's house. I want to buy a new car. Maybe I like to go to the bar and have a couple beers.
Okay,
Right?
let's do it this way. You start at age 35. Okay, so you only have 30 years to save.
All right.
Right? So you've had 10 years to figure this stuff out.
Okay.
Right? That's more realistic?
I think so.
And it's still a good number. It's $519,000.
So so here's the real crux of this math. If 10 years is $500,000.
Yes.
Right?
That's right.
And your contributions of $5,000 over that 10 years is not $500,000.
Right. It's a lot lower, right?
Right? 50 grand turns to 500,000. So if you wait, it's the cost of waiting.
Right.
So if you say, you know what, this $5,000 or a few $100s a month, I'd much rather blow at the bar.
Right.
Okay. Well, that's costing you $500,000.
Yeah, $500,000, $600,000 even. So to say that again, so if you start maxing out your IRA at age 25, that's $5,500 per year, and you save that amount for 40 years until you retire at age 65. At 7% rate of return, you have $1.1 million. On the other hand, let's just say you start 10 years later. You start at age 35 and do it for 30 years. Now you have about a little over $500,000. So you're short about $600,000, right? You have less than half. In other words, those first 10 years make a big difference. And talk about news you can use. The earlier you start, the better. Now, we know some of our listeners, they're behind the eight ball. And the truth is, then get started right now, because you can improve your situation no matter what it is at what age just by getting started right now.
And I think we're just looking at this in a silo too. It's like, all right, well, if you say $5,500, you're in 7% rate of return. Of course, all of this is hypothetical.
Sure, of course.
And then as the years go on, you have X amount of dollars. But guess what? At age 65, there's other factors that is going to affect your overall retirement. You will receive some fixed income, such as Social Security. So as individuals age, right, it's now you have a little bit more levers to kind of maneuver here, right, to have a successful retirement. And we've ran these numbers before on the show, but let's say if someone is 55 years old or 60 that has zero saved and they want to retire at 70, so they got a 10-year game plan. Well, usually at age 60, they might be in their peak earning years where they might be able to save a little bit more than $5,000. If you're one of the 80% of individuals that work for a larger employer that has a 401k plan, they have a match potentially as well. So maybe you put in the $5,000, they might match $2,500. So now you got $7,500. Or maybe you could get into $10,000 where they might match $4,000 or $5,000. And then over that 10-year time period, now you're working till age 70 versus maybe 65. But you know what? We're living a lot longer. We're a lot more active and healthy than ever before. And then now you're at age 70, your Social Security has increased in value as well.
Max, yeah.
Right. So then it's just looking, and then maybe you decrease your overall living expenses a little bit. So there's a lot of things that you can potentially do, but it always starts with planning. What are you trying to accomplish? What's really important to you in your life? And then putting things through the asset test. But I think that the delayed gratification is always challenging.
Well, so here's that example that you just went over. So you're at 60, you got nothing, right? And you want to get serious about saving. You can max out your 401k, $24,000, and I just threw in a $6,000 match. So just as an example.
Right.
So in other words, $30,000 going into your 401k for 10 years at 7%, you end up with $414,000, which is so far ahead of the average. It's unbelievable.
Right. So that could, at age 70, could create $20,000 of income, and maybe your Social Security, since you delayed it to age 70, might be, I don't know, $25,000-$30,000.
Yeah, even 40, but
on the low end.
On the low end, let's call it 30 plus the 20 that you have from your investments. So now you got $50,000, right? Plus you've got the $400,000 savings that you can draw upon in case of emergency, right? So it's you're actually in a decent spot.
Right. And so it's just, again, looking at what's important, map this out, and then put things through the asset test. It's like, okay, well, here, should I be saving or should I be spending? Well, I think we all know that, and I know a lot of individuals, they just say, God, I just can't find an extra dollar anywhere.
Right.
All right, well,
you're going to have to eventually, might as well start now.
Right, you're going to have to at some point. So better look at it now. Hey, real quickly, so let's say if you live in Southern California where Elle and I live, and you know what, maybe you don't have a lot of money. I'm going to go through real quickly. Maybe you move to Alabama.
Okay.
Have you ever been to Alabama, Al?
I have not.
It's an unlimited exclusion for pension income from defined benefit retirement plans. So if you have a defined benefit plan, hey, you got a pension, move to Alabama. Tax-free to you.
Well, so does Hawaii. I'd rather pick Hawaii.
Arkansas. How about Arkansas?
Are you going alphabetical?
You can get up to $6,000 in retirement plan benefits, including IRAs if you're over 59 and a half. You can go to Delaware. They give you about $12,500 of dividends, capital gains, interest, rental income, and distributions from qualified retirement plans. Once you're 60,
got it.
You get about $12,500 tax-free. Georgia, $65,000.
65. That's pretty good.
That's pretty good, right?
Yeah.
If you're for income, if you're 65 years of age or older, up to $35,000 if you're 62 to 64. Hawaii. There you go, Al. Unlimited from defined benefit pension plans. That's what you did. You looked. That's the only thing you looked in this article.
No, actually, I already knew that because we have a client that did that. But I did look at that just to verify.
And then how about Kentucky? You can up to $41,110 coming out of annuity contracts, profit sharing plans, IRAs. So depending on the state that you live in, or maybe where you potentially want to live, take a look at the tax law when it comes to that, because it's important. If I can pay less tax on those distributions coming out, and this is just on the state side, of course. You'll still have to pay federal
taxes.
Or you can move to a state that doesn't have state tax.
Yeah, like Nevada, Washington State,
Florida.
Let's see, Texas,
South Dakota.
Yeah, South Dakota, Wyoming, to name a few. Those are Alaska. Those are taxes without individual income taxes, and so that's even better than some of these exclusions. California, we all love California, but there is a sunshine tax, as they say.
Yeah, I mean, it can get up to about 13% here.
It can, 13.3.
And there's some whispering saying, hey, they might get rid of the state tax deduction if they lower their individual income tax rates.
Yeah, they might. It's being talked about. In fact, that's what's in the Republican plan, is to eliminate state tax deduction.
Yeah, that'd be great for Californians.
Yeah, so we get bumped in a higher bracket because of that.
Right, so you got to be careful, too, with some of these proposals that are coming out, depending on, all right, well, here, that's great, we get lower tax rates.
Right.
But then,
what's happening on the back end?
What's happening on the back end, right? Because taxes is revenue for the federal government, and we all know that there's a little bit of deficit there, so we can go supply side and say, hey, we're going to have that much more profitability because there's more cash on hand that we can reinvest, which is great, but there's still entitlements. There's still Social Security, Medicare. We have roads and, everything else in between that needs to be paid for. So that's why, again, planning is so important.
Time now for Big Al's List. Every week, Big Al Clopine scours the media to find the best tips, do's and don'ts, mistakes, myths, and advice to improve your overall financial picture in handy bullet point format. This week, 8 IRA-related mistakes young professionals and everyone else should avoid.
This is from Forbes magazine. This is a recent article, Joe. We started the show talking to young professionals. I guess sort of going to continue that a little bit. But anyway, this was written by Maya Kochru-Levine.
Okay, thank you for that disclaimer.
Yes. And she starts the article by saying, opening and contributing to an IRA requires a lot of nuanced decision-making. And it isn't just about making choices, it's about understanding why one option works better for your financial plan. She said that when she was opening an IRA, I was lucky enough to have both family members and an accountant point me in the right direction.
Oh, come on. You go online. Here's what you do. Fidelity.com. Open up an account.
Yeah, but
Vanguard.com, whatever.
But who does that at age 22? So she had some
Everyone
help.
At 22, if you're 80, then I can see why you might have some issues because you probably don't have a computer.
Anyway, so you want to know what the mistakes are? Number one is not understanding the distinction between a traditional and a Roth IRA. What's the distinction, Joe?
A Roth IRA is after tax. You can put the money in. It grows 100% tax-free. There's a couple of different caveats with a Roth in regards to when you can take the money out. It's a little bit more flexible than a standard IRA in the sense it's an after-tax contribution. All that means is that you take the money after you get your paycheck. Well, and that's the same as an IRA, but you get the deduction. So you can deduct it on your pay or on your tax return in April, and you might get a little bit of money back.
Right.
So it's after tax, money goes in, grows tax-free. A couple of things with Roths, though. It has FIFO tax treatment. What that stands for is first in, first out. So any dollar that you put into the Roth at any age, you always have access to it.
So you contribute, you can withdraw it without penalty.
You got it.
The contribution part.
Only the contribution. So if you're 40 years old, you put $5,000 in. 42, you need the money. You can always pull the $5,000 back out. No taxes, no penalties, no harm, no fault.
Yeah, I think a lot of people don't realize that. Now that $5,000 grew to $7,000, you can't touch the $2,000 of growth until you're 59 and a half.
Correct. Then the other 5-year clock when it comes to Roths is that if you do not have a Roth IRA established, let's say in your older, over 59 and a half, so you're 65, and you put the $5,000 in, the same rule applies that you can always take your contributions out at any time, but now you have to wait 5 years to take that earnings out versus the 59 and a half rule. So it's 59 and a half or 5 years, whichever's longer.
Right.
And so what I would encourage a lot of you to do, if you haven't established a Roth IRA yet, you have until April 15th of this year. We're in 2017. So we still have some time that you can make a 2016 Roth IRA contribution. So maybe you put $100 in it. It doesn't matter. If you've never established one, that would start your 5-year clock January 1st, 2016.
Right, all the way back to there.
All the way back to Jan 1, 2016. So if you do not have a Roth IRA, you want to get this 5-year clock started, I would consider highly, if you can't afford the full contribution, just put something into it. The IRS doesn't care how much is in it, as long as that account is established and funded with at least $1. But I don't know where you can find an investment for $1. So it's probably going to be a couple $100 or maybe $1,000 or something like that.
Probably a good way to start. And by the way, not everyone qualifies for a Roth IRA contribution. If you're single, your income has to be below $118,000 to do a full Roth IRA, $5,500. And once it gets to $133,000, you can't do a Roth IRA contribution anymore. If you're married, those phase-out numbers are between $186,000 and $196,000.
And that's for 2017. If you want to still go for 2016, it's a couple bucks less than that. 184, 194.
That's right.
No big deal.
That's right. So,
but I guess you could put money into a traditional IRA and then convert it too.
You can do that if your income is too high.
Yes.
Right.
So if you're under 70
right.
and a half, just try anything or talk to a qualified professional to see how you can get a couple of bucks into the Roth, because that's such your 5-year clock.
Yeah. And number 2 mistake is choosing a traditional IRA just for the immediate tax deduction. And again, this is directed towards young professionals. And they quote our friend Ed Slott. Ed Slott says, recommends millennials choose the Roth IRA over the traditional one. He says that contributing to a traditional IRA to get the tax deduction is ultimately not worth it. And the reason it's not is because, you think about it, you're in a lower tax bracket probably, so that IRA deduction is not saving you that much in taxes, but yet if you get into a Roth IRA, you could have 30, 40 years of tax-free growth. That's gigantic.
I don't care if you're in the highest tax bracket, Clopine, because let's do the math here.
Okay.
Right? Let's say you're in the 40% tax bracket. Okay. I put $5,000 into the Roth IRA. I'm going to pay, instead of getting that tax deduction of 40%, right? 40% of 5,000 is
40% of 5,000 to 2,000.
$2,000. I
wasn't even listening, but I still picked it up.
Yeah, look at that. Look at the big brain on Big Al. Right. So that's a $2,000 tax savings. So that $5,000, it grows to I don't know, you pick a number, $100,000. Like, let's say over the next course of 30 years.
Sure.
Okay.
Right. Okay.
Can that happen?
That could happen.
All right.
Yep.
So then you pull out that $100,000, and let's just assume you're not in the 40% tax bracket. You're going to be in a lower bracket. Let's say you're in the 25% tax bracket.
Right.
So I got a couple $1,000 tax savings for that $5,000 contribution. Over the next 30 years, it grows to $100,000. Of course, this is all hypothetical. I'm just proving my point.
Okay.
Then I'm in a lower tax bracket in retirement, 25%, almost half my bracket.
Sure.
I pull the $100,000 out. What do I pay in tax? $25,000.
Right.
It's not worth it. Who cares about the $2,000? You're going to save the $25,000 in the future.
Yeah, I think that's right. And actually, if we want to go real world, here's what happens: you save $2,000 in tax and you spend it.
Yes.
So there is no advantage.
Right. And then the deduction that you get is not a true deduction, in my opinion. I think it's just a loan, because you got to pay that deduction back when you pull the money out of the account.
Right.
Right?
Yes.
So,
Joe, another one is not opening an IRA as soon as you qualify. And it's difficult for young people to do that because they have so many other things tugging at them, like student loans.
Tugging at
them. Yeah. You like that word. Yeah.
Go ahead.
Credit card debt, student loans. They want a better car, right? They want to move into a better rental, or they want to save for down payment for a home, or they want to start a family, all this stuff. Yeah. But the point is, start your IRAs early. We just went through the math. You're maxing your IRA at age 25. You got over $1 million by 65 at a 7% rate of return. If you start at 35, it's about $500,000.
So $5,000 per year.
Yeah.
What is that? What we did for how many years?
$5,500 for 40 years at 7% comes out to $1.1 million. That's what you got.
There you
right?
go.
So if you start at 35, you end up with about $520,000. Right.
So you put in $200,000 and it grew to $1.1 million, basically at a 7% growth rate.
Yeah, that's right. Yeah.
And so now going back to my tax math, $200,000, right? And if you pay tax, like you got that tax deduction of 25% on $200,000, 25% of $200,000, Big Al, is what?
That is $50,000.
$50,000. So you saved $50,000 in tax, but now the $1.1 million that you have to pull out of the account, guess what? It's all tax at ordinary income.
Right.
So if you use that same 25% on $1.1 million, that's about what,
That's about $270,000 tax that you pay.
So I don't know. It's pretty simple to me. 270 versus 50. Right? That's why Roth IRA, man. I'm telling you. And then I know some older listeners now are saying, "Well, that doesn't apply to me." We're going to dismiss that myth later.
If you need a free financial assessment, if you missed an episode of the podcast, or if you're just dying to see what Joe and Big Al look like, visit purefinancial.com. Access the Learning Center with resources, white papers, and webinars on investing and financial planning. Subscribe to the podcast and see clips from the Your Money, Your Wealth TV show. All at purefinancial.com.
We're talking about 8 IRA-related mistakes young professionals need to avoid, and the next one is not contributing early in the year. Why would they say that?
Well, then you get more tax-deferred growth the sooner that you get the money in there.
Sure, and even better, if you put it in a Roth, then you get more tax-free growth.
If the market grows.
Yeah, if the market grows, which we learned today is about 7 out of 10 years, 70% of the time.
70% of the time, the market goes up. 30% of the time, the market goes down.
Yeah, at least that's based on prior history. That's no indication of future, but that's based on prior history. Yeah, in the
future, it's probably going to be 30-70. Just our luck.
Who knows, right? But that's what we know. Those are the stats from, I think, was it 1927 on that, or maybe it was 1940. It was 1945 to today.
Well, I mean, if you even go back to 1927, it's about 68.
Yeah, pretty close. Yeah. Pretty close. But that makes sense. Get the money in as soon as you can. Another one is not opening an IRA because you have an employer-matched 401k. So you're allowed to do an IRA with a 401k?
Absolutely. That's very key for individuals that want to save more money.
Sure.
Right? Is that if I'm fully funding a 401k plan, one of the myths is that you cannot contribute to any other type of retirement plan. And that's not true. You can absolutely still contribute to an IRA or a Roth IRA, depending on your qualifications. So we encourage you. Here's Joe Anderson's list of savings.
Oh, the order of savings?
Orders of savings.
Okay,
right?
So you got X number of dollars. Where do you save into first?
You go to the 401k plan first if you have a match.
Okay.
So let's say you have a 4% match. You put 4% into your 401k plan up to the 4% match.
Okay, so let's say I make $100,000 a year just to make it easy math. So I'm going to put $4,000 into the 401k.
You got it.
Right? And then I can save $10,000, so I got $6,000 more.
All right, so now I'm going Roth IRA.
Okay,
so then what you do is you go 4% match. I'm going to go to the 4% match, $4,000. Hey, I still have a little bit more money. Now I'm going to go back to the Roth. I'm going to maximize the Roth IRA if I qualify.
Okay, so I'm going to do a Roth contribution, and that has nothing to do with my employer. That's my own account that I set up at whatever place, the bank or brokerage house or discount broker or whatever.
You got it. Individual retirement account. It's your account, your account number, your name on it.
Right.
You control it. You invest it how you choose.
And you can pick a traditional IRA and maybe or maybe not get a tax deduction. You can do a Roth IRA, no tax deduction, but it grows tax-free.
So then if I still want to save a little bit more money, right, then I go back to the 401k.
Okay, so in that example, I have $4,000 in the 401k, then I put $5,500 in the Roth. I still got $500 extra. I put that back in the 401k.
You got it. Right, and then now let's say you get a big bonus. All right. Well, then you keep going to the 401k plan until you maximize the 401k plan.
Yeah.
Right. And then if you still have dollars that you want to save, then that's where you start a brokerage account. And then that's where you start funding, mutual funds or stocks or bonds outside of any type of retirement account. So it'll just be in your name only.
Yeah. Okay. I agree with that. So 401k to the match, Roth IRA, Roth contribution, back to the 401k, max that thing out, and then start saving a non-retirement account.
You got it.
Yeah. Okay. I like that.
So here's a few other things too, is that let's say that your paycheck or the amount of income will not allow you to save that much.
Sure.
All right. But maybe you sold an asset, such as a property at a profit, or maybe you got an inheritance, or maybe you got a gift, and you have money sitting in cash that's over and above your cash reserves.
Okay.
So I'm just going to use $50,000. $25,000 of that is my cash reserves. The other $25,000, I'm not sure what to do with. Right? We get this question all the time. Hey, I just inherited 25 grand, 50 grand, 100 grand. What do you suggest I do with this? Okay. Go back to the sequence orders again. Go to the 401k plan, go to the match, right? Then you go to the Roth IRA, fund the Roth IRA, $5,500. If you're over 50, go to 65. Then go back to the 401k and max that thing out. And I know some of you are saying, hey, I don't have the income to do it. Yes, you do. I don't care if your paycheck comes back and it's only $500. You have the cash. Now you're going to spend down some of that cash, because the only way to get money into, let's say, a qualified 401k plan or 403b or an employer-sponsored plan has to come through your paycheck. You can't just just write a check from your checking account to deposit it.
Right.
Right. So here, your paycheck, your net pay is going to be reduced, but now you have that cash. It's just like stealing Peter to pay Paul.
But you end up with money in the accounts that you want to.
You end up with the monies. Yes.
So you normally, let's just say you have a net payment, net check, a payroll of $1,000, and now it's $500. So you're $500 short because you put another $500 in the 401k. Well, you just take $500 out of your cash account to pay for your bills, right? And in effect, now you've taken the cash in a roundabout way and got it into the place you wanted to.
You got it.
Yeah.
Right. So it's just thinking outside the box here a little bit. Right.
Right.
So then, all right, then you go back, max out the 401k. Hey, I still have some money left over. Then that's when you start opening up the brokerage account. Right. And then how should it be invested is going to depend upon, all right, well, how's that 401k invested? How's the Roth IRA invested?
Yeah.
And then you want to have
the whole picture.
You got it. Then you start taking a look at, an overall strategy on all the different accounts, because there's been multiple times, I know you guys will call us and say, I just inherited $100,000. What do you think? Where should I put it? Okay, well, let's take a step back first, right? And just use those orders. I think more and more people might be a little bit more successful.
I think you're right, Joe. Here's another one. We see this all the time. Cashing out your 401k from an old job instead of rolling it over to an IRA. And here's where this happens is maybe you're in your 30s or 40s and you end up with a 401k of 10 grand and you think, well, that's too much of a hassle to roll that into an IRA. And so you cash it out, you spend it, and then you realize when you've spent it, not only do you have to pay income taxes on it, but you pay penalties because you cashed it out before you're 59 and a half. And in most cases, between federal and state taxes in California, you're going to approach, and penalties, it'll be about 50% tax. So that $10,000 that you didn't roll over cost you about $5,000. And that becomes a big surprise at April 15th.
Your Money, Your Wealth is presented by Pure Financial Advisors. To get your free financial assessment, call 1-877-222-6044 or visit purefinancial.com. That's 1-877-222-6044 or visit purefinancial.com for your free financial assessment.
We're talking about 8 IRA-related mistakes that young professionals need to avoid, and it turns out this is true for all of us. Number 7 is being too eager to use your IRA before retirement. Have we ever seen that?
Multiple times,
all
brother.
the time. All the time. And when you take your IRA out before retirement, of course, you're jeopardizing your retirement lifestyle. That's what it's for. But you're paying a hefty tax because in most cases, you're probably taking it out before 59 and a half. So you're paying a 10% federal penalty. In California, you pay a 2.5% penalty. Plus, you got to pay income taxes at your normal tax rate, right? And if you add all these together, you end up at about a 50% tax rate in California.
How many times have we seen people take that money out to buy real estate?
All the time. And then they're shocked when they owe taxes. They thought, well, I thought I'd get a write-off when I bought real estate.
Right.
I mean, we see that time and time again.
It's like, well, Joe, I needed a place to live. All right, yes, I understand that. But you don't have to pay cash. Take it out of your retirement account. And
right.
Where are you going to come up with the additional couple $100,000 in taxes and penalties for doing it?
And sometimes, Joe, we see people that are close to retirement. They're in their 60s. They can take it out, and they do for the wrong reasons. Like they take out a big lump sum to pay off their mortgage.
Yep.
Pull out $300,000 to pay off the mortgage.
Well, it makes me feel good and not have debt. I'm not going to have any debt.
I'm debt free. I'm good.
Yeah, but now you're back in debt because you owe the IRS another couple $100,000. I mean, I would much rather have a small interest payment that I can write off to a mortgage company.
Right.
Versus having the franchise tax board looming over me.
For sure. I mean, just that simple example, and we've seen this before. This is why we're talking about it. We've seen people that their final year of retirement, they got all kinds of extra severance and whatever they got, right? Vacation pay. So their salary is higher than usual. Then they pull out several $100,000 out of their IRA 401k to pay off the mortgage. So their taxable income is like $500,000. And they get this bill, right, at April 15th. They owe $200,000. And guess what? They don't have it.
Right.
So then they go back to the IRA. They pull out $200,000. And the next year, they owe $100,000. They got to pull out that, right? And this just continues, goes on and on.
A couple of things, and we'll get to your final point there. It brought something up.
Okay.
Your retirement date. right? There's usually two very popular dates that people retire. Right? You want to take a guess, Big Al, what those two dates are?
Well, 62 is probably one of them.
No, I mean like during the year. Let's say I'm retiring this year. There's going to be two dates that I'm probably going to pick.
You're going to pick.
What would you think those two dates are?
Let's see. I'm going to say one would be, I don't know, like the 1st of January.
Okay. Wrong. That's the right move. Coming from a CPA, he knows when to retire. No, it's usually the end of the year, December 31st. I'm going to make it through 2017.
Yeah, and then be done.
And be done, right? Or I'm going to retire on my birthday.
Yes, we do get that a lot.
Right?
You're right.
So it's either birthday or it's the end of the year. I'm going to, hey, I'll give the company to the end of the year. I'm going to let them know. Or, you know what? I turned 66 in June. I'm done. Right? I'm out of here. So I'm fine with the June date.
Right.
But be careful with the December date. Right. Just as Al was talking about, it's like, all right, well, let's say if you worked for that company for quite some time and you have the sick pay that's accumulated or vacation pay and things like that.
Right.
Well, they pay that out to you in your last paycheck.
Yeah.
And so if I wait until December 31st and say, all right, I'm going to close out the year, well, that last paycheck might be your largest paycheck, but then you have that 12 months of earnings.
Right.
If you take Big Al's advice, wait a day. Retire January 1st, then you don't have the 12 months of ordinary income of wages.
Yeah, so you're in a much lower bracket for that year. And this happens more often than you would think. I mean, how many times maybe it's happened to you or somebody that you know has been offered early retirement from their company, right? And so early retirement, it's of course, it's all over the place, but often you get some sort of salary to retire, maybe 6 months or 3 months of salary, and they don't necessarily pay it over time.
That's a nice way to say, hey, you get the hell out of here.
Get out. We don't want you. But they'll give you a lump sum. Right? And if you left in December and then you got a 6-month lump sum, it's like you made a 1.5-year salary in 1 year. Do you think that throws you in a higher tax bracket? It certainly does.
Right. And then you probably might have already fully funded your 401k plan at that point or whatever employer-sponsored plan.
Right. So you can't do any more.
You can't shelter it.
Right.
But if you wait till January and let's say you get a $30,000 check, well, you could put $24,000 of that right into your 401k plan, max that plan out for the following year, and then you just have a lot smaller check that's taxable to you. So, just FYI, a couple of little news you can use.
Little tidbits. We're giving solutions today, aren't we?
Well,
Big time.
Yeah, I mean that guy. It's like, hey, fellas.
He goes, you brought this thing up and you didn't say what the solution was.
Yeah.
Well, that's all right.
I forgot what he was.
It was about we were talking about.
I forgot his email. I was going to talk about that, but it was some app about passwords.
Yeah, we were talking about how to password protect everything, and we didn't really have a great answer, so he gave us one.
Yes,
it was an app. I forget the name of the app.
Well, you know what? Next week.
Yeah, next week. We'll get on that.
We will get the solution next week.
Number 8 here is not pushing yourself to contribute more early on. And this is key, Joe. I mean, because...
Do what now?
Pushing yourself to contribute more early on. In other words, maybe you open up an IRA, if you even think of it, and you just put a few $100 in it. If you can put more money into it, it's that compound earnings for 20 years, 30 years, 40 years that makes such a difference in your retirement nest egg.
So what did we learn today? Save early, save often.
Yeah, that's like not new news, is it? It's like we didn't talk about pay yourself first. That's a good one. What is that?
We're really getting complex.
Yeah, we are.
Yeah, pay yourself first.
Yeah,
right, and then pay everything else after that. Right?
Okay.
Like the IRS does that to us. You know this.
That they do
because our tax bill isn't really due until April. But guess what? They garnish that stuff out of our.
They take their cut, don't they?
Because they know if they didn't.
Yeah, we wouldn't pay it. They do know that. And the same way with a retirement plan, pay it first, right? If you have a 401k, that's the easiest and best because it's right through your payroll.
Absolutely.
But if you don't have a 401k, then go down to your discount broker, your bank, whatever, and set up an auto withdrawal from your checking account on the same day as your paycheck. And so that it automatically goes into your IRA or your Roth IRA. You don't even have to think about it. Right. And you just do $100 a paycheck or $200 or whatever it is for you, right? And it's automatic. And so then it's not you're not tempted at that point to spend it because it's already out of mind, out of sight, out of mind.
Yeah. You don't have it to spend it.
Right. It's
and
gone.
Then don't look at the statement saying, well, I still got this. Well, maybe do I want to buy that? No. Forget about it. That's that's money for next 5, 10, 15, 20, 30 years, depending on your age, of course.
Yes, exactly. So, Joe, when we talk about IRAs and we talk about Roth IRAs, and boy, we're big believers in Roth IRAs, and certainly to do a Roth contribution is a great way to go. To do a Roth conversion can be even better, because then you're taking money out of your IRA, you're out of your 401k, you're converting it to a Roth, and yes, you pay taxes on what you convert, but then all those dollars in the Roth grow forever tax-free, and it's the growth, it's the income, it's the principal is tax-free, and that's tax-free forever. That's a pretty long time. If you pass away, your spouse or kids, it's still
forever.
Tax-free.
Did you hear that one? That's a pretty long time.
Infinity. So I think
that's a pretty long time.
I think, Joseph, that if more people would contribute to Roth IRAs and convert to Roth IRAs, they would gain more control over their taxes. Do you agree with that?
I would agree with that. I absolutely
Were you listening?
would. No, I wasn't.
It's time to dip into the email bag with financial questions courtesy of Advisor Insights from Investopedia and you, the Your Money, Your Wealth listeners. Joe and Big Al are always willing to answer your money questions. Email info@purefinancial.com, or you can send your questions directly to joe.anderson@purefinancial.com or alan.clopine@purefinancial.com.
We didn't get any we got some complaints about us not giving solutions. And so we apologize.
Yeah, it's okay. We want your criticism. We want to know how to make this show better.
And please, yes, absolutely. You can. Feedback is welcome because it helps us grow.
Yeah. And if it's negative, we send it to our marketing department. And if it's positive, we read it.
Yes. No, I'd like the negative ones.
You do?
Yeah, because I can't pronunciate words often, like just there.
What'd you say? Let's regoop.
Yeah,
yeah.
And then it's like, then I have these little ticks that I do. I'm from Minnesota, right?
Well, that explains a lot.
Yeah, so I still have a little bit of an accent there.
Yeah, not much.
Yeah. Well, all right. So we're getting into this is from Investopedia Advisor Insights. That's full disclosure. They send me questions weekly, and because I answer them, well, Big Al does, and I take credit for it.
Do you send them the podcast?
No.
You don't?
Oh. So, first one, right out the gates here. Title of this email is, How do I review a financial advisor's credentials? Oh, that's interesting.
Yeah.
I'm very interested in working with a specific investment advisor who has recommended a fixed annuity.
Okay.
I have been unable to find any information on this individual from FINRA after 2010. How do I check them out?
Great question. I'll let you answer that one.
All right. Well, FINRA, so that's broker check. So if you go to brokercheck.com, then you can kind of take a look at the past history of a particular broker. All right. And so it can tell you if there's, basically if they, stolen a pack of cigarettes when they're 16.
It's on there, huh?
It would be on there.
Okay.
For the most part.
Yeah. Okay.
Right? Any legal issues that they've had, bankruptcies.
Okay.
Or I think more importantly, customer complaints.
Right.
Hey, this person swindled me this, or they sold me this, or did whatever. And you can kind of take a look. So that's brokercheck.com. You can just put in your individual broker's name.
That's a national thing?
Oh, yeah. It's under FINRA.
Okay, yeah.
Okay?
Right.
And that's a regulatory industry. So this individual is like, all right, well, here, I went to FINRA. But here's what this is telling me. There's nothing there from 2010. So what is that? They don't have a securities license anymore.
Oh, okay.
That's what that's saying.
Oh, that's not good.
Well, not necessarily.
Well, if he's selling a fixed annuity.
Well, you don't need a securities license. Right.
Right, for a fixed annuity.
This individual is like, you know what, I'm just going to get in the annuity business.
Sure.
I don't want to deal with the securities industry. So they're selling this person a fixed annuity.
So if it were a variable annuity or equity indexed annuity, he'd need the license?
No, not an equity indexed annuity, too. That's the problem. An equity indexed annuity is still a fixed annuity.
Okay.
All right.
It's just how it's calculated, I guess.
It's still fixed. It's still fixed. What they're stating is that they're crediting interest based on a particular index,
okay,
such as the S&P 500. But if you actually do all the calculation. There's no. If someone just said, here's a fixed indexed annuity, and said the likelihood ranges of return is anywhere from 2 to 4% over 30 years, then I'd be totally fine with that disclosure, because that's basically
more accurate.
But how they sell it is that, hey, would you like stock market like returns with no downside risk?
Right.
Because then you have to take a look at what's the caps, because what those products do is that they'll cap out that individual. Let's say the market does 5% in a month, and they might have a cap of 2.5% for that month. Hypothetically, there's hundreds of different iterations here.
Sure,
right. So then you don't get the 5%, you get the 2.5%. But then the next month, let's say the market's down 5%, well, that will wipe out the 2.5% that you just made. So they take a look at a point to point, depending on how long that point is, right? So
I guess the point is, I mean, the S&P could earn 10%, but you wouldn't necessally earn 10%.
Not even close to that in most cases, right? So with a fixed annuity or fixed indexed annuity, you do not need a securities license.
Got it.
You don't need your Series 7. You don't need a 65, or they're not investment advisor. But the problem is that with a lot of these fixed annuity sales type individuals, they might say, Al, you got this 401k plan that's full of mutual funds, that's in the market, that is a security.
Sure.
And they're given advice on that to roll that thing out into, let's say, a fixed annuity or fixed product.
Got it.
You can't, you need a securities license to do that, but every day that happens, right?
Got it, yeah.
So there's a lot of different things that you might want to take a look at. So if someone's selling someone a fixed annuity, how do you look them up? Well, first of all, look at their credentials, right? So is there any initials behind their name? There's basically maybe 4 that matter.
Okay.
Everything else is garbage, in my opinion.
What matters?
I would say a CPA, like yourself, CPA, PFS, which is a personal financial specialist.
Yeah.
CPA sort of
CPA PFS.
Yeah, whatever. Okay.
Whatever.
Yeah, I know. It's really important. Listen to me. Whatever.
Whatever.
Who cares? It's a CPA. That's Big Al. Tell him Big Al sent you.
Right.
Certified Financial Planner, CFP. I think that's the gold standard in financial planning.
Yes, agreed.
There's the Chartered Financial Analyst, CFA.
Yeah.
All right. And then the CHFC. That's a Chartered Financial Consultant.
Okay.
In my opinion, those are the ones that you want to look for. So again, CPA, CFP, all right, CFA, Chartered Financial Analyst, or CHFC, Chartered Financial Consultant. Those have very rigorous tests. You have to have bachelor's. I mean, there's a lot of different, there's ethics, and then there's everything else in between, right? Then there's hundreds of these other designations.
Yeah, which no one knows.
CRLCP, I'm a Chartered Retirement, fund specialist.
Sometimes you get these cards, they must have 7 or 8 acronyms after their name.
So that's first. If they don't have that, I might look elsewhere, first of all. Okay. But if you really like the individual, then you're like, well, what's the background? You have to look at the background. Okay, well, FINRA, they stopped at 2010 in this example. Then you got to go to the Department of Insurance, because they're selling you an insurance product. So you got to see if there's any complaints there. So it's kind of a pain. I wish it was a lot easier. But I think the easiest thing is to say how you're compensated. Is there a conflict of interest, and what are your credentials? And if you feel good with all of those, if they say, I make a commission, I don't have any credentials, and the insurance company pays me the commission and you don't have to worry about it, those are red flags. If someone says, yes, I'm a certified financial planner, I have 15 years of financial planning experience, here's how I'm compensated via fee only, then if that agrees with you, there's, eliminates a lot of the conflicts, then maybe that's who you go with. That was a long-winded answer for this quick question.
Very quick question.
Get social with Your Money, Your Wealth and Pure Financial Advisors. Follow us on Twitter at YMYW Show. To connect with us on Facebook, LinkedIn, YouTube, and Google+, just search for Pure Financial Advisors.
Number 2. Here's the title, Big Al.
Okay.
Should my extra income go towards my 401k, Roth IRA, or non-retirement account?
Oh, I like it.
Wow. All right. I'm a 26-year-old professional with a 401k a Roth IRA, and a non-retirement account. I contribute enough to my 401k to get my employer's match, and I try to max out my Roth IRA every year. But of those 3 accounts, where should my extra income be going? I'm not sure what's the best focus at this point in my life. Additionally, I work for a nonprofit, so I only have an extra $5,000 to $10,000 to play with.
Okay, 5,000 to 10,000.
At 26 years old.
That's good. Good for him. I mean, that's great.
Or her.
Or her. Yeah, sure. I guess it didn't say. Sorry, ladies. You heard Joe's order of savings, which I tend to agree with. The first thing that you do is you save into your 401k plan up to the match. So this individual's already doing that. Excellent. The second, then you stop. Then you go contribute to a Roth IRA. It sounds like they're doing that too. And that's up to $5,500, right? If there's still extra, you go back to the 401k and you put some more money there. You can get up to $18,000 into 401k. Now they probably don't have that much, but that would be the order. But I'm gonna do a little exception, Joe.
Yep.
And
I know where you're going with that.
Yeah, and that is let's just say that you do your 401k to the match, you do your Roth IRA, and you have a goal, right? Like saving for a down payment for a home. Well, that's okay, right? Put it in a non-retirement account and, saving for that goal. And then maybe in 3, 4, 5 years or whatever it is, you can buy that home.
Yeah, absolutely. And I was thinking the same thing. I think with my order of savings would be strictly for a retirement goal.
Correct.
If you had no other financial goals, right? But of course, we all have other financial goals. This individual's 26. Hey, maybe I want to buy a new home, right?
Yep.
Or maybe a wedding. I just got married, or or
honeymoon,
maybe what's your
whatever.
cash reserves?
Yeah.
What is the actual balance of it too? At 26, maybe he already has a couple $100,000 saved. I don't know. Well, then does it really make sense to keep jamming a lot more money into the retirement account?
Right.
So there's always exceptions to the rule.
Yes.
Thank you very much for that.
Good question.
Okay, next question. Will I be exempt from the early distribution penalty if I roll over my 401k to an IRA within 60 days and take out distributions? Summary. I'm 57 years old. If I retire and roll over my 401k to an IRA within 60 days of separating from my company, okay, where I have the 401k, will I be exempt from the 10% early distribution penalty in the IRA if I take distributions out of the IRA before 59 and a half? I heard conflicting stories on if the 401k is rolled over within 60 days of separating, whether the IRA is also exempt from the 10% early tax penalty, just like a 401k would have been.
Good question. So let me tell you what the rule is. If you retire, in other words, separate from service, and you're 55 years of age, you can take money directly out of your 401k, and you have to pay income tax on it, but there's no penalty. Once you roll it to an IRA, you lose that status. And so now it's an IRA, and you're going to pay penalties until 59 and a half. So in this particular case, if you want to roll over part of your 401k to an IRA, great, go for it. But the money that you want to withdraw between 57 and 59 and a half, leave that in the 401k. So when you take it out, there's no tax penalty.
Great advice. So I guess say it a different way. I'm 57. I separated from service. I need some additional cash flow.
Right, because I'm retired early.
Sure.
Which is right, yeah, fine.
Okay. And then so it's like, all right, well, here, let me roll that money into an IRA. He's talking about a 60-day rollover here, too.
Yeah,
so
it's a little different. Yeah.
Let me explain the 60-day rollover, and then I'll reiterate Al's advice. 60-day rollover is that you can take money out of a qualified account, right, IRA, and you have 60 days to put that money back in. There is no taxes. There is no penalty on those dollars as long as those dollars get back in the retirement account within a 60-day time period. For instance, January 1st, right? I retire. February 1st, I need a little bit more cash. I take $20,000 out of my IRA. Okay? So it's like, okay, well, now I have 60 days, right, from that February 1st date. Okay, so then it's like, all right, if I don't make that money back within that 60-day time period, then that's a distribution. Then it would be taxed and penalized. But if I get the money back in within that 60-day time period, then I'm all good. So it's like kind of like you're just taking a loan, from yourself?
In essence, and you can only do it once per calendar year. And this is a little different. I mean, about 2-3 years ago, they changed the rule because people were doing it with every single IRA, and they would set up 10 IRAs so they could keep doing this shell game. And the IRA said, no, you can't do that. You can do it once per year, and that's it. And then in that example, you take the money out on February 1st, and you put it back in within 60 days. Well, then you can't do it again until February 1st of the following year.
Right. It's a calendar year.
Calendar,
Yeah.
right.
It's not a...
Or it's not. It's a
12-month period.
It's not a calendar year. It's a 12-month.
12-month. Yes.
A 365-day period to be exact.
Yes. We're tight. We're tight today, folks.
Except for leap year, 366 day.
Okay, and then so going back to Al's point, it's like, all right, well, here, man, if you need a little bit of capital, well, keep money in the 401k plan.
Yeah, you're allowed to take money out of the 401k directly for your own purposes. Yes, you pay income taxes on it, but no penalty. And that's it's just a different rule. 401k, you separate from service. You're 55 years of age. You can pull money out and no penalty. IRA, it's 59 and a half. They're different rules for different kinds of retirement accounts.
And you don't have to roll everything out of the plan.
Yeah, you can do some of it.
Yeah,
whatever.
You got $500,000. You put $250,000 in the IRA. You keep $250 in the 401k. Then you take the distributions out of the 401k. That avoids the 10% penalty because you're under 59 and a half. And then once you reach age 59 and a half, then you can roll it all into the same IRA. Whatever you want to do. If you made the mistake already, though, and you already moved it into the IRA, and you're 57 and you do need the money, there is a way around the 10% penalty. It's using the 72T tax election or separate equal periodic payment. But then there's 3 different ways to calculate that, and that may or may not be enough money for you to...
Yeah, I think a lot of times it's not enough.
Exactly.
Yeah. Right.
Yeah.
When you look at the calculation.
You would think, oh, man, I got $1 million. All right, well, here, you can take $12 out.
Every other week.
Yeah, so it's a little bit more than that, but you want to make sure that you run the calculation to see exactly how much that you can take out in a 72T tax election. At 57, if you started at 57, you would have to wait until age 62 to unwind it because it's a separate equal periodic payment. What that means is that you have to take the same amount of money out of the account each year until you're 59 and a half or 5 years, whichever is longer. And here's one from Tennessee.
Really? Wow.
What should I do with my 401k when I leave for grad school?
Okay.
Man, I'm 25 years old and know nothing about investing. I've grown a small 401k at my current job, but I'm leaving soon for grad school. What is the best option to transfer it? Should I transfer it to a different retirement account so it stays untaxed? I would especially like to choose my own investments based on my own ethical choices. What is the best option for my case?
Well, I like that question. Good for you for having a 401k. So
why do you like it? Tell me more specifically now.
Because I like to answer. I like to hear myself answer a question.
Okay.
So anyway, there's a couple choices. Well, at least 3 choices, I suppose. One is you can leave it in the 401k. Most plans don't. You don't have to take it out, even though you don't work there. Another one, although if it's a small balance, some plans will make you take it out. You could cash it out, which we wouldn't necessarily recommend because you got to pay taxes and penalties, or you can roll it to an IRA. And based upon what your stated goals are, to have more investment choices that you have more control over, that's probably the best answer is to roll it out to an IRA. There's no taxation, then you have complete control over what you invest in. Yeah,
it sounds like with ethical choices.
Right. So maybe there's some question on the investments in the 401k.
I'm thinking social responsible.
Could be. Oh, you're thinking that way. Yeah, you're probably right.
What did you think?
I don't know. Not thinking. I was answering the question.
Right. So if you want to, let's say, open up an individual IRA, you could go socially responsible, where you don't invest in, oil companies, alcohol or cigarettes or tobacco.
all those the sin type of companies.
Is that what they are?
That's what they are.
Sin companies. Oh my God.
You haven't been to church lately, have you?
Hey, wow. Yes, I have. Is that what they say at your church? These are sin companies.
Yeah, every week. Do not invest in sin companies. And I'm sitting in the front row. They're looking right at me.
So, but in your own individual IRA, you could invest in an individual stock.
You could,
right?
Or there's
what's the holiest stock you can purchase, Clofine?
The holiest? I don't know. I'll think about it.
Yeah.
I'll have my answer next week.
All right, there you go. We'll do some research.
Yeah.
Okay, well, we got time for maybe one or two more.
Okay.
Okay, so are T-bills safer than an indexed fixed annuity when you take into consideration the debt our government has? I'm considering an indexed fixed annuity.
Okay.
I'm 60 years old and have $125,000 to invest. I do not trust the market, especially since it is rising so quick.
Okay.
So there's a lot of things going on in that email. We can break them all down.
Well, I'll start with the safety issue. In spite of the debt in our country, a T-bill is definitely safer than a fixed index fixed annuity because our government, think about it, our government is in debt, but it also prints money, right? An insurance company cannot print money. So if they get into trouble, they don't have the ability to print money like our government has.
What do you think this gentleman heard, or lady, to feel this way? This is a full-on fear sales tactic.
I'm going to guess that they went to an advisor that focuses on insurance-type products.
Fixed indexed annuities here.
Yes.
Yep. Mm-hmm. Indexed fixed annuity. He got it backwards.
But that's okay. Fixed indexed annuity. Yeah, I would agree with that.
Right. So it's like, well, here, no, look at the debt that we're in. $18 trillion in debt. 19.
Why would you trust a T-bill?
Oh my God, the T-bills, that will blow up on you. The U.S. government is going to default. But guess what? American Equity Life Insurance Company, they're going to weather the storm.
They're fine.
They're fine. Nothing's going to happen to Allianz when the U.S. government is blown up.
Right. They'll be fine.
Come on. Jeez Louise.
I mean, when you think about it, I mean, just go back to my money printing thing. So if you invest in a bond in California, which is generally, municipal bonds are generally pretty safe, it's still not going to be as safe as a government T-bill because California does not print its own money.
Treasuries are the safest investment on the planet.
Yes.
They call it the risk-free rate. It's a riskless asset class.
Right.
The entire world
invests in T-bills.
So
the entire world doesn't invest in fixed index annuities?
No. No. But Lafayette life insurance company, they're a lot stronger than the...
Yeah, I thought...
Well, look at the balance sheet of this insurance. Yes, insurance companies, you know why they're so profitable is because they got pretty good salespeople on the front line telling people that, you know what, the U.S. Treasury is not safe,
right?
But this fixed indexed annuity is.
So all this, like China, for example, there's a lot of extra capital there. And where do they don't invest in fixed indexed annuities?
I don't know.
Maybe they do.
They might be going to a dinner seminar, get a free steak, and then next thing you know.
Hey, China, did you know? No, the T-bills are the way to go if you want safety.
All right, and I'll wrap this thing up, too. It's like, all right, well, I don't trust the market. Yeah, most people don't necessarily trust the market when you are, I guess, uneducated on basically how the markets work.
Sure.
And, well, the market is rising so quickly. There's a lot of reasons why the market is rising so quickly, if you think it's rising so quickly. But let's put things into perspective. All right. So the market is at 22,000. I'm going to tell you it's at 20,821. Okay. So 21,000.
Got it.
So I don't know the exact date. This is off the cuff. Please do not hold me to this. But I'm going to go back to, let's say, 1997-ish. Okay.
Okay.
That's when the market hit 10,000. Okay.
Right.
So 10,000 to 21,000.
Right.
That is roughly doubling, correct?
Yeah. Right.
But 1997 to 2017 is how many years, Alan?
That's 20 years.
20 years. So it took 20 years to double.
Right.
Is that craziness?
No.
Isn't that that's what you would expect?
Yeah, that's kind of
low.
Low, actually.
It's not, because we had a couple of bad years in there.
So that's about, 3.5%?
Sure.
On average.
On average, right? So you got to put things kind of in perspective. Of what God, I said perspective a lot of times. I apologize.
You did.
God, yeah, awful. See, send me an email. Count how many times I said perspective.
We're going to get a lot of emails this week. It
is absolutely awfulness.
And I just started tuning in. I can't believe you've been around for 10 years.
I know.
We can't either.
Craziness. Now, a few things to consider here, too, is that lower tax rates or the anticipation of lower tax rates is spurring a lot of market activity.
Right. I would agree with that.
And here's why, is that if I'm a company that has, let's say, real simple terms, $10 million of profits, okay? And next year, let's say if my corporate tax rate gets cut in half, all right, that $10 million of profit might go to $15 million in profit.
Because I'm paying less tax, right?
Because I'm paying half in tax.
Right.
Right? Give or take, right? This is not exact science. I'm just throwing out numbers. But that's if I don't do anything else. I just do the status quo.
Right.
I just keep all of my customers fine, right? I don't, I sell the same amount of widgets. I'm not killing any records here. But all of a sudden, my bottom line increases significantly.
So people are willing to pay more for that, aren't they?
Well, wait a minute. Yeah, because I'm more profitable.
Right.
And then guess what? When you invest in a company, you want some of that profits.
Right, dividends.
And so the company's value is going to increase just due to the fact that if they do nothing else, they're going to be paying less tax. Less tax means more profit. That means the company's stock price has to go up. It has to.
Right.
It's not going to go down because of it. It's going to go up. Now, here's what's going on in the marketplace, and I'll shut this down in 2 seconds, is that I would say maybe, let's say 60% of the market feels that, yes, tax rates are going to get cut. 40%, maybe not so much, right? It's not 50-50 or else we wouldn't see this move. Maybe it's 70-30. So there's still people that might not think it's going to happen. And as we get closer to certain dates, they talked about it last week. What's his name wants to have it by August, May. Throwing this stuff out there. Well, as we get closer to these dates, if nothing happens, we're going to see a pullback in the overall markets. All right? So just anticipate that. If it happens, the market's going to shoot up. If it doesn't happen, it's going to blow up. Just know what you're holding, and there shouldn't be any surprises in your overall portfolio. And that's it for us today.
So to recap today's show, retirement is expensive, $700,000 on average, so don't mess it up. Save early, save often, save in the right order, and retire at the right time and in the right place. For more smart retirement advice, subscribe to the podcast at yourmoneyyourwealth.com through your favorite podcatcher or on iTunes, where you can also check out our ratings and reviews. And remember, this show is about you. If there's something you'd like to hear on Your Money, Your Wealth, just email info@purefinancial.com. Listen next week for more Your Money, Your Wealth presented by Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision. Your Money, Your Wealth opening song Motown Gold by Carl James Pestka is licensed under a Creative Commons license.